Hey everyone, welcome back to Corporate Decoder, the place where we unpack the hidden stories inside SEC filings and give you the real scoop. Today we're looking at Perella Weinberg Partners, and their latest filing isn't about soaring profits or a dramatic product launch. Instead, it's about something much more fundamental to how they do business and how often shareholders get a say on executive pay. So what's the big deal here? Well, picture this. At their annual meeting back in May, shareholders voted on something called a say on pay proposal. This is basically a chance for investors to give their non-binding opinion on how the company pays its top executives. Think of it like a regular checkup for executive compensation to make sure it aligns with the company's performance and shareholder interests. And the results of that vote are what this filing is all about, or rather an update to the original report about those results. Now, here's the key takeaway from that shareholder vote. Most investors at Perella Weinberg Partners said they're happy to vote on executive pay just once every 3 years. That's a pretty long time between those advisory votes. Normally, these votes happen every year, so this means the company is going to change its schedule based on what the shareholders said. They'll now have these say on pay votes every 3 years unless shareholders decide otherwise at a future meeting. The company's board looked at the results and agreed with the shareholder recommendation, meaning they're going to stick to this 3-year cycle for advisory votes on executive compensation. This filing really highlights how shareholder proposals can directly influence a company's internal policies. While the vote itself is advisory, meaning the company doesn't have to follow it. In this case, the board did. It's a good sign of responsiveness. However, the decision to move to a triennial say-on-pay vote could also mean less frequent direct oversight from shareholders on how executive compensation is structured. It's a trade-off between reducing the frequency of votes and potentially loosening the immediate reins on executive pay decisions. For investors, this means they'll need to pay close attention to the company's performance and executive compensation is structured. It's a trade-off between reducing the frequency of votes and potentially loosening the immediate reins on executive pay decisions. For investors, this means they'll need to pay close attention to the company's performance and executive compensation over these longer 3-year periods to gauge if the alignment is still there. Looking at the broader context, Perella Weinberg Partners is an independent financial services firm. They offer many services like strategic advisory, capital raising, and asset management. Their business is heavily influenced by market conditions and the deal-making environment. Frequent say-on-pay votes are often seen as a way for shareholders to keep management accountable, especially in industries where compensation can be very high and directly tied to deal success. So shifting to every 3 years might be seen by some as giving management more autonomy between these votes. Perella Weinberg Partners date August 1, 2025, Caddy Case Alexandra Gottschalk at a Bards as Alexandra Gottschalk Addy Alexandra Addo Chief Financial Officer scroll. This amendment was signed by Alexandra Gottschalk, their Chief Financial Officer, on August 1st. This date aligns with the filing date, showing the official confirmation of the board's decision on the voting frequency. Now, what's my take on all this? Well, the fact that the board is respecting the shareholders' vote on the frequency of executive pay votes is a positive sign for corporate governance. It shows they are listening. However, the move to a 3-year cycle for say-on-pay votes is something to watch. It could mean that for 2 years out of every 3, shareholders have less direct input on executive pay decisions. This could be either a good thing, allowing management more room to focus on long-term strategy without the constant pressure of annual votes, or it could be a concern if executive compensation practices start to drift without regular shareholder scrutiny. It really depends on how the company performs and how transparent they are about their compensation policies in the interim. For investors, the key is to monitor the company's financial performance and executive compensation practices start to drift without regular shareholder scrutiny. It really depends on how the company performs and how transparency without the constant pressure of annual votes. Or it could be a concern if executive compensation packages closely between these triennial votes to ensure they remain aligned with that. What's your take on this decision from Perella Weinberg Partners? Do you think a vote every 3 years makes sense for executive pay, or is that too long a gap? Let me know your thoughts in the comments below. If you found this deep dive helpful, give this video a thumbs up and subscribe to Corporate Decoder for more breakdowns of what's really going on behind the financial headlines. And don't forget to join our growing community on Discord. The link is in the description. Thanks for watching, and we'll see you in the next one.